Good evening, everyone. And Scott, good evening to you as well. Are you with us? I know your plane was delayed as you flew back from a quick 4-day trip offshore, but you're back with us. So good evening to you as well. Scott, if you can just confirm that you're with us and that you can talk.
Awesome. Yeah, Lyndon, I'm here. Thank you very much. And hopefully you guys are going to be able to hear me loud and clear. You do try and get these things sorted and make sure you're back on time. But unfortunately, sometimes airplanes let you down, and mine was delayed by more than an hour and a half.
Well, welcome, Scott, and I'm glad you can join us, lead us through this. And also a very big welcome to Jean and Tom. We will be introducing you guys in a bit more detail later, but it's really great to have you joining us this evening. Thanks for coming online.
Great, thanks, Lyndon. Glad to be a part of it.
Thank you for having us.
Absolutely, and welcome then to all our participants. We have a very full house tonight. A lot of people have signed up to listen to the third section in terms of offshore investing made simple. We've had 3 weeks already. This is the third session after the previous 2 weeks. And Scott, I'm going to hand it over to you. You were the person who ran and took us through those 2 previous sessions. So I'm going to hand it over to you just to give us a recap of what is this series of workshops and seminars about, and what have we covered already in the last 2 weeks?
No, thanks, Lyndon. So just very quickly, this is your team from a commercial perspective. Gabby has been running the webinars with me. She at the moment is in Kruger. You've got Alex to help on the wealth consultant side. You've got Siska, who's helping with, and then you've got KYC.
Scott, we are losing you quite a bit, so I'm not sure if I know you. Scott, we are losing you. I'm not sure if I know you're trying to find a place with the best reception so you can pull over, but we are losing you. So what I'm going to suggest, just sure. Thanks, Kathy. Thanks, Siska, for the update. Yep, we're just trying to get Scott into a place with better reception.
I've pulled over.
Scott, can I suggest you turn your video off? All right, so guys, I can't hear Scott, so I think what I'm going to do is I'm going to keep going. Luckily, we do have, I think many of us have been on the last 3, the last 2, so it'll just be a very quick overview and highlights as to what we covered in those previous sessions. Can I just check with you, Jean, and maybe Tom? It looks like Scott has stopped sharing his screen, so let me pick up where he left. Give me a second. If you could just confirm for me, Jean, when you can see the screen, or anyone in the chat panel. I see that some of you have already been dropping us messages about Scott's voice breaking up, so not a problem. Great, thank you. Appreciate Siska and Aubrey and Kathy and Maria. Appreciate that. So our Wealth Migrate Deals team, this is something we went through last week. We have Rian van der Faber, who's our Chief Investments Officer, myself and Scott, who sit on the investment committee of any deals that we put through onto the platform. And then on the operational side, we have a deal team that is responsible for due diligence and for managing deals through their life cycles once our investors are a part of that. And that's Kaliz Jing, who is in the USA on the ground, managing our USA structures where required, and Kelly Cullett, who actually sits in Panama. So we're a pretty globally diversified team. This is just a small section of our team. These are the ones more specifically related to deals. And I think you have had time over the last 2 weeks to meet some of them. The last 2 weeks, we really covered the why. Why do you want to have an investment strategy? Why do you want to have an offshore investment strategy? And where in that strategy does real estate sit? What are the regulations involved? It's a highly complex arena for investors to be in, and we have made it simple through making sure that we tick all the regulation and authorizations that are needed for you to be able, for the first time, to be able to invest offshore very easily at home from the swipe of a button. And that's really the exciting aspect of what digital transformation is doing to the investment world. Now, obviously, that means there's tax. Whenever there's a good investment, there's going to be tax. The taxman wants his piece, and that's what tonight is all about. How does the tax work? And we're very excited tonight to have Jean and Tom joining us to be able to talk us through some of the implications of tax. If you would like to, please join the conversation. There are different ways you can do that. We'd love you to have, please join on the chat, ask your questions, share your thoughts as we're going through this webinar. At the same time, there is a live event page and resources. You can see it on the screen. It is online.wealthmigrate.com and then /offshore regulation. We will make sure to share this with everyone. Most of you will have it already, but please feel free to join the conversation. There's a whole section on resources, on additional information that you can find on that page. So really the recap of these last 2 weeks, what are people looking for offshore? Why are they wanting to invest offshore? And there really are 4 key purposes to offshore investing. To preserve your wealth. I think this one is very much, everyone wants to diversify your asset base. You want to make sure you're not only holding all your investments in rands. You want to be able to have them in offshore stable currencies, so that even if the rand is fluctuating, that your wealth is being preserved at a global level. Many people want a plan B, just in case, you never know. There's peace of mind knowing that you have offshore money that's earning you good income. Most of our focus is on how do we give you income generating deals. And all of that really leads to freedom. Once you are financially secure, you have the freedom to be able to make more decisions once you have an offshore investment strategy. And that's really the focus of Wealth Migrate, is helping you get to a point where you have financial freedom. So in the first week, Scott really covered the 4 components to making sure that there's financial success. Number 1 is don't lose money. I think that's a strategy that we might underestimate, but often there are investments that get promised that are extremely high returns but have risk. A lot of the experts in the financial advice space will, however, make sure that your number 1 strategy is don't lose what you've got. Once you've done that, then figure out how to grow it, but number 1, don't lose it. This does relate to risk and reward. Tax efficiency and diversification are all 3 aspects you need to take into account to make sure you're not losing money, and then to figuring out how to grow the money. Let me move on. Lynn, I was about to answer your question, but I'm going to save that for a little bit longer because I think it's a great question. Lynn has a question for us about wills, which we will come to later on in tonight's session. So how does it work? At Wealth Migrate, it's very simple. We have a worldwide collection of institutional quality suppliers. What I mean by that is these are companies, real estate companies, alternative investment companies, that's particularly focused on giving investment products to institutions, funds, investment firms, and we want to make sure that we can access that quality of investment listed on our platform, and then give it through to yourselves, the investor, so that you can access institutional quality offshore deals from wherever you are in a safe, secure environment. So what you do is you sign up on our platform, complete your profile, you fund your wallet, and you invest. That process can take very quick. The Cisco, who is online tonight, in case anyone has additional questions around that towards the end, we can connect you directly, is responsible for making sure that you are verified as an investor. It's an important part of our process from a compliance perspective. And once you've done that, you can invest into any deal literally at the swipe of a finger in 30 seconds. And that's the magic of digital investment platforms. Last week, we did a session on making it safe and simple, and directly related to that was compliance. So for those of you who were not online last week, we had Rian, our compliance officer, talking through the compliance journey, as well as the due diligence that is covered when we list a deal and a sponsor onto our platform. And that really brings us to the track record. And I think there's a lot of different statistics that we as a platform are paying attention to. Internally, though, our most important statistic is the one about how many of our investors reinvest the funds that they have in their platform. So if there's an investment that pays them out a dividend or they get their money back after a deal, how many of them immediately take that money and put it into the next deal? That is the ultimate indication of success for us. And that number at the moment, we have a 78% funds reinvestment rate. When someone gets funds, 78% of the time, those funds are immediately reinvested rather than being withdrawn to pay for a holiday, because they like the fact that their money is in the system. It's a great investment and the platform is working. So of all our track record, that is the one that we are definitely the most proud of. And that brings us through to tonight, which is really about tax. Now, before we talk about tax with Jean and Thomas, and before I introduce them officially, just a note that we are very excited after a year and a half of not being able to go out and meet our investor community face to face. We are with full COVID compliance. We are going on our offshore investor breakfasts, which were legendary before COVID. At least we thought they were. I hope our investors agreed. It was a real opportunity to meet us and our team and to meet our partners who are a part of our broader ecosystem to understand and engage around offshore investing. The dates are the 1st of June in Cape Town, the 8th of June in Johannesburg, and the 15th of June in KwaZulu-Natal. We will be talking about this a little later, but just a seed planting to get you thinking about where you're going to be on those dates, and really an invitation for you to come and join us. And that feels like I've been speaking for a lot. So I'm very excited to start handing over to Jean and Tom. Guys, thank you very much for joining us. They are from Tax Consulting South Africa. You can have a look at their website. We will give the address later. We have met them and have consulted with them around many of the tax issues that we are currently facing, and wanting to share that information with other South Africans who are interested in offshore investing, but also generally interested in real estate investing and what the tax consequences are tonight. And I think tonight's conversation is going to be in two different sections. We're going to talk generally around tax, but we're also going to have a look at what is the evolution of digital investing and what does that mean from a tax perspective. And before I hand over to them to do that, their managing partner, Jerry Buerta, lives in George, just down the road from where I live in Knysna. I think you can read for yourself the pedigree of Jerry and his team is significant. They have years and years of experience. They have a footprint across South Africa, which for us is always one of the key requirements when we find partners, because this means that our partners are able to serve you wherever you are in South Africa. And joining us tonight,
Lyndon, sorry, just I mean, to that point, there's 140 people in the team, and so for us, we're dealing with a team of scale, which is exactly what we want, so that they can help our high net worth clients.
Absolutely, Scott. And two of those representing tonight, we're very excited to be joined by Jean and Tom. Guys, welcome again. Rather than me doing an introduction, we have you on the pictures, but maybe you can both just say hello, good evening, and maybe just introduce yourselves and give us a bit of context as to your role in the tax space.
Great, thanks, Lyndon. Good to be here this evening. My name is Jean. I'm the head of tax technical at the firm. I'm part of the legal team, which comprises of around 22 attorneys. We deal mostly with tax disputes, tax planning, tax advisory, drafting technical opinions. We've also assisted LexisNexis in drafting now the second edition of an expatriate tax textbook. We make submissions to Parliament on policy formulation. So we are very involved in the tax space in general. Tom?
Thank you, Jean. I'm Thomas Lobben, Legal Manager for Cross-Border Taxation. I deal mainly with individuals around cross-border tax issues, around double taxation and the application of double tax agreements. And I am a part of the legal team, but just to feed into what we do as a firm a little bit further, we also offer a range of services across a full service suite, including accounting, SIPC registrations and maintenance, secretarial services, tax practitioner services, financial immigration, and more. So we're a very well positioned firm. And thank you once again, Scott, for the compliment as well.
Yeah, 100%. And I think, Tom, what we were really excited about not only is the breadth of your team in terms of the 140 professionals, but also the depth of your knowledge base. You're not just focused on one area. You have a really comprehensive coverage of tax issues facing South Africans, including what happens on their offshore investment aspects of their portfolio. So really excited to have you both here tonight. Thanks very much for joining us. Scott, I don't know if you want to add anything to that before we head on to the actual meet of tonight. Are you back
I think
online?
the only thing I will say, the only thing I will say is that I think is really, really important is that we at Wealth Migrate don't try and be specialists in everything. What we specialize in is finding good quality partners. And so what tax consulting have forgotten about tax, we don't even know. And so for me, it's a real honor and a privilege to have them here, and we really appreciate their time, their pedigree that you've already mentioned, Lyndon. And I think the purpose of tonight is to run through some of the general pain points that we experience with our clients and the questions we get asked, but equally for the people to be able to participate and ask any questions that they want in a Q&A environment, and then take it from there. Tonight is almost like a tax fireside chat, if you want to call it that, with really the intention of starting the conversation. The only thing I would say is that we're not giving any tax or financial advice tonight, and the tax is a very specific and unique solution to each individual. So although the team are going to be giving broad brush perspectives to questions, it can never be taken as verbatim as financial advice for you as an individual.
Thanks, Scott. Absolutely. And you're right. Tonight we are going to start the conversation, but we're certainly hoping that all the participants tonight will join in the conversation and help channel where it heads. And to Scott's point, the question we get asked the most, or the scenario that we get asked the most by our South African investor base is as on the screen. It's people who are understanding that they are wanting to create a wealth portfolio over time that will support them to get to financial freedom, whatever that means for them, and that they want real estate investing and potentially offshore real estate investing to be a part of that. And I think their questions are then, well, how do we do this in a way that's the most tax efficient? And that's really the core of our conversation tonight. We did reach out to our community and ask for specific questions that came through on this pain point. Some of the things that have come through to us have been, for example, what are the tax implications if I buy a property in my own name? What structure should I use? Should I use a trust? Should I use a company? What about if it's an investor house or a flat or a holiday? What's capital gains tax? I'm just going to keep reading these out quickly just to give you a sense of the questions that come from our community. What deductions can you make? Can I deduct my mortgage payment? If it's the only property I own, what happens to capital gains? So there's a whole bulk of questions that are coming in around what's the best structure for holding investment properties? What is the kind of capital gains? What can you do about it? And John, I think this is where we're going to hand over you to give us this overview to really kind of help the investor understand the space better from that perspective.
Great, thanks, Lyndon. So I think what we'll do is we'll give a broad overview of how taxation works in South Africa, dealing with the basis for taxation, and then looking at capital gains tax and how that works. And that will inform how we address the questions, which will, after the discussion, we'll run through quickly. So I think to understand the tax perspective on offshore investments, I think it's important to understand how the South African tax system works as a whole. And the intention is not to get into too much detail, but rather just to give a broad explanation. So South Africa operates on what we call a residency basis of taxation, which means that South African tax residents are subject to tax on their worldwide income. There are certain exceptions and rules that must be considered, but the general premise is that if you are a South African tax resident, you must disclose and pay tax on income from any source across the globe. And residency is determined by two tests in South Africa. The first is what they call the ordinary resident test, which looks at if your permanent or your real home is situated in South Africa. So for someone who lives in South Africa without being internationally mobile and without an established home in another jurisdiction, this is then you will be considered a South African tax resident. So for most of us on this call, we will be ordinary resident and therefore tax resident in South Africa. There is also another test which looks at your physical presence over a 5-year period, but this is more for inbound expatriates or people who don't really have the intention to reside in South Africa on a permanent basis. But I don't think we need to get into too much detail there. So we'll accept for purposes of this discussion that all of us are tax resident and proceed on that basis. So the general rule for worldwide taxation, it has some nuances, but especially depending on the type of income that you earn. And there are also a bunch of rules applicable to double tax treaties, which may give you some relief in some instances. So I think it's important that we look at a couple of streams of income that we can deal with briefly. And especially those that you might encounter when investing offshore. And I think the most important one is where you acquire and dispose of assets, which brings capital gains tax into the equation. So I'll just briefly explain how this works, because arguably this is the most relevant depending on your investment strategy. And you'll encounter these when you dispose of any assets locally and abroad. Certain assets are subject to relief, but let's look at how the system works in general before we get into that. So your capital gain is determined by the proceeds you receive from the disposal of an asset, less the base cost of that asset, which is essentially the purchase price of the asset plus any ancillary costs incurred in the acquisition of that asset. And if I'm going to try and go slowly here, because this is important, especially for looking at what type of structure you want to use when investing offshore and locally. So the gain on your disposal, which is essentially the profit that you make from disposing of your asset, is added to any other gains that you might have had during the year of assessment. And if you are a natural person, what you can then do is you get what they call the annual exclusion. So you take your total gains and then you deduct the annual exclusion, which is an amount of 40,000 Rand per year. And it's important to stress at this point that the annual exclusion does not apply to companies or trusts. It only applies to natural persons. You then, if you take your total gains and you've deducted your annual exclusion, you take into account any potential capital losses for the year or for previous years, and then you arrive at your net capital gain for the year. And then to determine your taxable capital gain, we apply what we call the inclusion rate. And this is also very important to determine the vehicle that you use, because the inclusion rate for natural persons is 40%, whereas for companies and for trusts, it is 80%. And what this means is that once you've arrived at your net gain, you multiply that amount by 40%, and that amount then gets added to your taxable income, your other income, your salary, your rental income, and whatever that might be. And that is then taxed at your marginal rate in terms of the normal tax brackets. So if we look at a quick example, if you, for example, buy a house in the UK for 1 million Rand, and 5 years later you dispose of that property for 2 million rand, your capital gain is essentially 1 million rand. If you are a natural person, what you then do is you deduct the 40,000 rand, which gives you an amount of 960,000 rand. If you don't have any other capital gains or losses for that year, you apply the inclusion rate to that amount. So in other words, 40% times 960,000 rand, and then you arrive at an amount of 384,000 rand. This amount is then added to your taxable income. So if you have a salary in addition to that of around 1 million rand, you add the 384,000 rand on top of that, and then you tax it in accordance with the tax tables. If you break it down and you want to calculate the effective rate of any capital gain, what you can then do is, if you fall in the highest tax bracket, which is 45%, you take the profits that you made, you multiply it by the inclusion rate, which is 40%, multiply that by 45%, and what you then arrive at is an effective rate of 18%. So for natural persons, you will never be taxed at a higher rate, an effective rate of 18%. So that's important also for our discussion later when we get to structures of companies and trusts and the like.
John, can I interrupt you there for a second?
Sure.
We got some questions flowing through, so some really good questions. And to all our participants, please do feel free either in the chat or the Q&A to drop your questions. So Kathy asked, are there different exclusions for shares and property in terms of capital gains, or is it all treated the same? So irrespective of the underlying asset, if it's a capital gain, it's a capital gain and a capital gain, and that's what it is.
Yeah, so that's a very good question. We do, so if it's an immovable property held, for example, in your personal name, then your calculation would be exactly as I've explained it now. So if it's a movable property, then you take the profit, you deduct the annual exclusion, 40% of that is added to your taxable income, and then you pay tax on that. There is a different treatment, however, if you have shares in a foreign company. The 8th schedule to the Income Tax Act makes provision for relief in this instance. So if you derive a gain from the disposal of foreign shares or shares in a foreign company, that gain is tax-free if you held more than 10% of the shares in that company, and you held the shares for at least 18 months, and the shares are disposed of to a non-resident. So in other words, a non-tax resident at market value. Then there's no capital gains tax on that disposal. And the latter requirement, the one that it must be disposed to or sold to a non-resident, is to encourage repatriation of foreign funds to South Africa. So if you sell shares, there is a potential tax efficiency there for you. So if instead of selling the property itself, you sell your share in that company, you stand to have a favorable tax treatment there.
Great, thanks, Sean. Follow-up question is from Francis. Francis, thanks for your question. And probably more of a question for myself to answer. And it's for all the deals on the Wealth Migrate platform. Is the income always paid out as dividends from the SPV holding the property? And how exactly do we declare these dividends in our SA tax return? I can answer the first piece, and then John or Tom, if either of you want to add to it, please feel free. Francis, the way we declare our returns is based on two things. Firstly, what is the nature of the return from the deal itself? So if the deal is distributing a dividend, then we transfer that as a dividend. If the deal is distributing capital gain, then we will transfer it as capital gain. On the platform itself, you will be able to request a tax statement. In about 2 weeks, you'll actually be able to go onto the platform and download it completely yourself, setting your own dates. Our tech team is currently pushing that out through development, so that should be there for you in about 2 weeks' time. And that will state very clearly for you what the nature of the return is, so that you can take it into account in your tax statement. What's really important, and it's almost worth a session just by itself, is to note that we have a very clever group of tax professionals both in the US, in the UK, and South Africa, who have helped us figure out the most tax efficient route to get money back to you. And what that means is that sometimes, in particular, for example, a deal from the US, your quarterly payments or return are actually coming back to you with a significant piece of that being called a return of capital. And that is completely tax-free. There's no tax on it. There's a very good reason for that. I'm not sure if I'll necessarily have time to go into it tonight because I really want to focus on Jean and Tom. But we do on the back end, we are constantly looking for the most tax effective way to get money back to you. That is one of the very legal tools we use, is to return quarterly payments back to you as a very high portion return of capital, because there's no tax on that for you, instead of giving it as a dividend. So if we have time later tonight, I'm happy to go into more detail if people would like, but on the platform, it will tell you what the return is and how you should declare it in your tax return. I don't know, Jean or Tom, if either of you want to add to that when there's the comment on how exactly do we declare these dividends in our SA tax return?
Sure. So I think then perhaps it serves to discuss how foreign dividends would be taxed if they are declared to you. And as a first point, it is perhaps best to distinguish between two taxes levied on dividends, which is income tax potentially and withholding tax. Withholding tax will be levied in terms of the laws of the country where the company is situated, if it's a foreign company. But this may also be subject to a treaty depending on the country where the company is situated. And generally, where there is a treaty, the withholding tax will not exceed 15% if the recipient is a natural person. Although some treaties impose a lower limit. I know we have an agreement with, for example, the Netherlands, which may result in a zero withholding tax. And then if you look at it from a South African perspective, in other words, would the dividend be included in your income and taxed in South Africa? That really depends on your percentage shareholding in that company. If you hold at least 10% of the shares in a foreign company, dividends declared by that company will be tax-free in South Africa. And where you hold less than 10% of the shares, a portion thereof will still be exempt. And the exempt portion is represented by the ratio of 25/45, which essentially means 44%. So 44% of your dividend will be tax-free. The rest will be included in your taxable income, and again, will be taxed at your marginal rate. So it is always, if possible, best to ensure that you meet that 10% threshold.
Sean, I love that. So to all our investors, if you're thinking about putting money into the next deal, I significantly suggest that you increase the amount you're investing so that you hit 10% of our SPV. That would be a superb investment decision. I say that as a joke. Please, that's not financial advice. Sean, thanks.
Yes, sorry, Lyndon, that is important, and it is one of the hallmarks or the bedrocks of our anchor investors. So just, don't be too facetious about it, because it is actually one of the advantages for us of an anchor investor. And tonight we're not going to be going into an anchor investor, but if people want to know about what it is to be an anchor investor, and we've been doing it for 7 years, and it's what our key investors do, because they get a whole bunch of benefits to investing in the deals.
Fantastic. Jean, the questions keep flowing, so I'm going to keep taking it for another 2 or 3 minutes and then allow you and Tom to keep going, and we can come around again at the end. There's a question about what if it's a joint investment in the case of a married couple? How would that scenario that you talked us through change?
Well, it depends. If you are married, for example, in community of property, then your income in whatever shape or form is automatically split on a 50-50 basis, because you have a joint estate. So then you split and share the income that you earn from that. Otherwise, it depends on how the asset is owned. So if you have, for example, a property that's held 50-50 by you and your spouse, then the same would apply. Half or 50 would accrue to you, 50 would accrue to your wife or your husband, as the case might be. If it's owned in your 100% in your own name, then it's not possible to attribute your profits or your income to your spouse, even if you, especially if you do that by a donation or by some contract, because the Income Tax Act has specific anti-avoidance provisions that prevent you from doing that.
Great, thanks, Sean. Since the investment is offshore, sorry, here's another question. Since the investment is offshore, what exchange, this is a great one, what exchange rate should you use for proceeds and base cost when you have to pay tax? So are you effectively taxed on any currency movement as well?
So, well, to determine the applicable exchange rate at the time, I believe you have two options that you can choose from. You can use a spot rate, which is prescribed by SARS, or there's a weighted exchange rate that they use as well. And you can, as far as I know, you can choose which one works best in your favor to achieve a more optimal tax rate. There are sections that would tax you on exchange gains as well, if they are significant. But those are quite complex, but certainly you can be taxed on exchange gains.
If I could just add in there, because this is something that I do deal with quite regularly on the exchange rate. The spot rate that's applied is something that must be used from a recognized exchange for foreign currency in South Africa. And if you use the weighted rate, it's called the average rate of exchange. That's something that is provided by SARS and can be determined on a 12-monthly basis. But the caveat to this is that where a taxpayer applies one of those methods, they have to apply that method for the full tax year. You can't chop and change between.
Understood. So Vishlin, it sounds like if you invest 5 years ago at, let's say you invest $10,000, but at a certain exchange rate, and you get $20,000 back, but you've also made additional gain because the dollar has become, or the rand is devalued, then yes, it sounds like you will have the full rand benefit of what you've gained will be taxed, not just the pure dollar piece, if that sounds correct. There's a question here from Francis around where exactly are the SPVs situated that Wealth Migrate uses. We use UK SPVs. It's an extremely good regime for us. It's tax neutral. In other words, there's no tax that we pay at all in the UK. We pass through those funds straight through as our SPV receives funds. We pass it straight back through to the investors. So there's no withholding tax or companies tax that we pay on our UK LLP. So that's one of the reasons we use the UK. So that's, I think, Francis, I see that was also about how you can accommodate that in your will, which is an interesting conversation. We can certainly have that separately as well. Then Kathy asks, does SA law not say that dividend tax should be deducted before paying out foreign dividends? So that's an interesting question. If you're invested into a UK LLP, for example, and the UK LLP wants to distribute, it can do that without there having to be any withholding tax at the UK LLP level. Is that correct, Sean or Tom?
Well, I think that will largely depend on local United Kingdom legislation. So as I said, the withholding tax, which is effectively recovered and withheld by the local entity, is done in terms of the foreign laws. Your South African tax implications would be determined by our Income Tax Act, and for that purpose, it depends on your shareholding, which it can be tax-free if you meet that threshold.
100%. So Jean, so Kathy, the South African law cannot dictate to the UK LLP that it has to deduct taxes, because, you know, where would those taxes go? They can't, the UK government doesn't want them. So you get, in our case, our LLP does not withhold tax. We distribute it straight to you, and then you need to deal with it from that perspective. It does get slightly complicated on a US deal. We do have to pay some withholding tax in the US before we can give it to our UK LLP. But once again, we have designed our system extremely efficiently so that gets minimized. which is part of the reason you get a return of capital back from US deals, for example. But in essence, there has not been any withholding tax that you have to take into account when you receive your distribution from the UK LLP. There has not been any tax withheld at a dividend or capital gain level when we distribute through to you. There are lots more questions, but I'm almost, yes, Scott, I'm almost tempted to get John and Tom to keep going before we really run out of time because of all the questions.
No, that's exactly what I was going to say. Just for the essence of time, two things. I'd prefer if John and Tom can continue with what they wanted to do. The questions can keep coming through, and we can answer them afterwards. It's just for those that want to stay within the hour. And then also just to reiterate that they are joining us at the breakfasts, and the whole idea behind the breakfast is a balance between the theoretical and the practical. And so before the kind of tea break, it'll be the theoretical, and after the tea break will be the practical, and they very much are going to be part of the practical session as well. So, and we've also got a special guest that we want to introduce just now as well. So let's go back. You know what it's like with tax? It's an absolute wormhole. I mean, we can go left, right, up, down, and so let's hand back to Thomas and John and run through what they want to talk, and then we can come to the Q&A, and or we can delegate the Q&A through to the breakfast.
Absolutely. Thanks, Scott. Jean and Tom, back to you.
Great. Yeah, so I think our next segment might answer many of your questions in any event. But as Scott said, our attorneys will be at the breakfast, and they'll be able to answer any questions that you may have. And a lot of the questions posed relates on what type of structure you should use when you want to invest both locally and offshore. And the answer to this is really, it depends. There are cogent reasons to use a structure when investing rather than having your assets in your personal name, and asset protection and legacy reasons may be applicable in some cases. But if your primary aim is to pay less tax, depending on your structure, of course, then generally it is best to keep your assets in your personal name, actually, to avoid tax leakages. Other factors such as your exit strategy and the intended retention period may also be important, but from a purely tax computational perspective, structures may present less efficiency. And if we look at it from a capital gains tax perspective, as we discussed earlier, natural persons can use the annual exclusion of 40,000 Rand, which is not available to companies and trusts. Second, the inclusion rate for companies and trusts is 80%. And what this means is the effective tax rate on capital gains for a company is 22.4%, because the taxable gain is taxed at 28% flat. And for a trust, it's a 36% effective tax rate if it's taxed inside the trust, because the capital gain is taxed at 45% flat after you've included the 80% taxable gain. So if you compare that to a maximum effective tax rate of 18% for natural persons, the difference can be quite considerable. And the effective tax rate for individuals can also be far lower. If you didn't earn that much during the year and you didn't have any other gains, it can go as low as 10%, for example. If we look beyond capital gains tax, we should also consider the distribution of profits, where you keep the asset in a foreign company and you dispose of the asset. The profit will sit in the company, and that's important to note. It's not profits that is automatically yours. It must be distributed to you by means of, well, if you use a return of capital, it's a different story. But if you do it via a dividend, there might be a tax leakage there. So if you have more than 10% of the shares, the distributed profits may be exempt from tax in South Africa, but the gain will probably be taxed in the hands of the company in the foreign jurisdiction, whatever their corporate income tax rate might be. And it might then be subject to withholding tax as well. And if we assume that the foreign jurisdiction has the same tax rates as South Africa, your profits would be taxed at 28%, and your distribution is then subject to a 20% dividends tax. So effectively, your tax rate on that is 48% if you have to distribute the profits to the shareholder. But if it's situated in a low tax jurisdiction, or if there are favorable tax treatments for your specific investment, then it might make sense to put it in a company. Beyond that, there's a lot of other corporate income tax issues that you might have to deal with, which is very complex. Your company can be considered what they call a CFC, controlled foreign company, which can give you, and that's if you together with other South African resident shareholders hold more than 50% of the shares in a foreign company. Then there's a myriad of tax implications there if it's not managed correctly. Also, if the company in the foreign jurisdiction has no local directors and you manage the company from South Africa, then the effective management and control of that entity will be considered in South Africa, and SARS will then tax that company as if it is a South African tax resident, which sort of defeats the purpose of having an offshore company. In the same vein, if you as a director or the shareholder are actively involved in the operations of the company, or if you generate the profits from South Africa, in other words, there's no substance in the country where the company is situated, you create a taxable presence for that company inside South Africa, which again exposes the profits of that company to the South African tax system. So there's a lot to unpack here. If you want a more simple tax efficient structure, then off the cuff, the answer is probably to have it in your own name, depending on your circumstances. But it depends on in which jurisdiction you sit. If it's locally, I would 9 times out of 10 say it's better to keep it in your personal name, unless you want to use it for asset protection.
One thing there, John, that's also important. We did events pre-COVID where we were talking with a client, and she had a 70 million rand inheritance, and she'd done nothing for 7 years because she didn't know what to do, where she had analysis paralysis and was worried about which structure to use or how to do it. And what's really interesting is I find that often, I've set up 4 international structures myself, and I've made a lot of mistakes. I'm the worst person to try and educate people on what to do. I'm better at telling them what not to do. But my point being is that often people don't do anything because they've got analysis paralysis. And what we found, particularly with the technology and the platform and the fact that you can actually start with quite a small amounts now, it makes far more sense to start in your own name and actually do something than to sit around with analysis paralysis waiting to set up a fancy offshore structure and do nothing.
Exactly. I think that's a very good point. So while it's always a good thing to consider the tax implications from the get-go, rather start in your personal name before you set up complex trust structures and company structures, which may, in your circumstances, not necessarily be appropriate, in which case you might have to unwind those, which would probably be costly and might result in considerable tax leakages as well. So I think we can perhaps address the questions. I don't know, Tom, if you want to first deal with your segment before we quickly run through the questions.
Yeah, I'd love to pivot to Tom if you don't mind. I am conscious when we do these webinars that we try and keep them to the hour. We're never very good at that, especially when we're getting great engagement from people. So let's pivot to Tom so that we can get the meat from what he wants to share, and then we can go to the questions.
Thank you, gentlemen. Just a few general points on my side, and I'll do my best to keep it trite and short. Just a few of the challenges you need to be aware of, and mainly how technology can assist a person from a tax perspective, increasing safety and reducing hassle and costs. And this is just a little bit further to Jean's points on the impact of tax on offshore investments and how to structure their affairs. Another aspect is technology. At this stage, most would agree that technology is something that poses equal opportunity and risk from an investment perspective. While from a risk perspective, it now allows SARS to glean information on taxpayers' foreign financial affairs for audit purposes. For example, South Africa has automatic exchange of information, or TIEA, taxpayer information exchange agreements, with 83 jurisdictions around the globe. It's also allowed a much more efficient online rather than necessarily personal interaction with SARS on various matters as well. Correspondence is now sent via e-filing or email, and documents are sent and received near immediately in each case. To put it a bit more context, instead of waiting lengthy periods of time before you get feedback on the performance of your investments, for example, which may have in the past been sent on an archaic platform or forums such as snail mail, post, or fax. Nowadays, this information is freely accessible and often in real time, and allows an investor to track the performance of their investments far more effectively. Now, if you look at it from a tax perspective, this is incredibly important because it allows one to reconcile the information they need to inform the disclosures in their tax returns to SARS, and well within the periods required. With readily available information technology resources capable of handling large volumes of info, reconciling your figures and reporting it to SARS in a digestible format each year has largely become a secondary, if any, consideration for many. This also certainly reduces the accounting and tax advisory fees in determining the taxes payable and reporting this to SARS. So when you're looking for an investment partner, it's very important to make sure that you're with somebody who can meet the task from a technological perspective. They can report back to you wherever you are on the globe. They can consolidate that information. They give you the certificate that you need, or at least the statements that you need to satisfy the burden of proof that rests on the taxpayer from a SARS perspective. Another aspect is it shows intention. As John had mentioned at the beginning of his slot, the ordinarily resident test, which is driven by a taxpayer's intention, or more pertinently, whether an amount is seen as capital gain, capital in nature, meaning it's subject to capital gains tax and a reduced rate, or revenue, where it's otherwise seen as profit. This is much more easily proven in your correspondence with your investment advisor, or quotes, invoices, and general documentation that's kept in soft copy format. A partner who can meet you from a technological perspective and keeping things off of hard copy, shall we say, is also very important. A taxpayer needs to keep their documentation for at least 5 years following the submission of a tax return and a SARS assessment. If you think about how fragile paper is and how it has a propensity to get lost, having that on soft copy is absolutely crucial. And we've seen in practice far more often than not that a taxpayer's hide is saved by having some soft copy available of what they need as and when they need it. When SARS approaches you for whatever they're asking for, the rule is you have 21 business days generally to revert, and the last thing you need is to be scrambling through a library full of paper to get what you need in that regard. Ultimately, technology, using it to one's advantage, is something that's fast becoming more and more prominent the world over. You really want to make sure that you're well placed if you're talking about investments, and in particular foreign investment. With so much being possible nowadays, even in a post-pandemic world, we've seen in practice that being abroad for any stretch of time, the most important thing for them is to manage their tax and their obligations hassle-free from wherever they are. Other than that, it's just making sure that whatever structure is in place is efficient. Thank you.
Thomas, it's so interesting you say that, because one of the pain points that I think we solve for ourselves, and I speak for myself here, Lyndon, not for you, but the point being is that where you start investing around the world and you start having different structures and bank accounts and trying to manage properties, and I mean, it's an absolute and utter nightmare. And for me, you know, I'm terrible with admin, and the beauty of the platform to have everything in one place is so critical, you know, and it was to solve our own personal problems, and then obviously, you know, hopefully helping others solve their problem as well.
Completely with you. I mean, let's not lose sight of the fact that foreign investments are something that are on SARS's radar. And it's not a problem. It really isn't. As long as you are compliant and transparent and you're able to give that evidence as and when you need it, you're not a prospective SARS victim, shall we say. And so having a platform that is able to give that information to you when you need it is so, so, so critical. Yeah.
Brilliant. Lyndon, can I make a suggestion? There's you know, a number of questions that have come through, and we're sort of nearly getting to the hour. Lynn Schoen has been very quietly waiting to join us as well. And I would love to just pivot to her quickly and then run through what we're going to do at the breakfast. And then, you know, if anyone wants to, you know, remain on, we can answer some questions. I do want to repeat that the idea tonight was really to introduce tax consulting as one of our partners. I do acknowledge as well that we've got members in 158 countries, and that tonight has been a focus on South Africa. You know, we've got partners that are experts in other countries, but tonight, because of the roadshow around South Africa, the focus was on South Africa, and we're very, very excited to have Thomas and Jean and the team that are going to be supporting us at the breakfast, where when people are asking questions, we can actually answer their questions, and whether it's in a group dynamic or in a one-to-one dynamic, I think, you know, that will provide the. Again, I want to repeat what I said. When I was first introduced to Jerry, the thing I liked was that there's 140 professionals in the company, and that allows our high net worth investors to be able to sit down one-to-one, no matter where they are from a geography perspective, and to find a solution for themselves independently. So, Lyndon, do you mind if I pivot to Lynn quickly?
Absolutely, Scott, please do.
Awesome. Lynn, thank you very much for joining us this evening. And I thought I would bring up a nice little picture here, Lynn, of us out in the African bush. This was at the end of 2019, just before COVID changed all our lives. And you can see here we were having what we call a wealth weekend out in the bush. But Lynn, you know, from your perspective, it's interesting because the timing of tonight is perfect, because you are a chartered accountant yourself. And I'd love to know just your personal journey of why you wanted to start investing, you know, offshore to start off with.
Yes, well, I think I started off with your company about 6 years ago, and I think it was fairly self-evident. We were right in the middle of the Zuma period, that South Africa was going nowhere, and the Rand reflected that. And what's the point of saving if even if you get a good return, you're still declining in terms of an international currency, and anything that you would like to buy, like imported goods or holidays overseas and whatnot, were just becoming progressively less affordable. So I thought it was pretty necessary to have some assets overseas.
And then from your perspective, once you started to think, okay, right, I want to go overseas, what was that journey like? You know, what did it involve, and you know, how did you go about it?
I must admit, I did have a couple of slips before I found your company. One of the large financial institutions around here in South Africa was offering offshore investments, but dear me, they didn't send statements. When you did get statements, you just saw that your investments were going down and down, even though you could see in the press that the stock markets in those countries were actually going up. And eventually, you know, just from sheer lack of any kind of comeback or answering of email, well, then even really emails those days, you had to phone. You know, I just pulled out what was left and left in a huff. Yeah, so that was the worst one. Other ones I just considered looking at, but oh, yeah, it's extremely difficult. You look at these people, you don't know them from a bar of soap. you know, their promises look good. They say that you can buy a house, you know, for next to nothing and rent it for a huge amount. And then you go and look on these platforms like Hello Peter and find that these people have got a whole collection of irate investors on their tail. Yeah, so I was really pretty suspicious when I came across Wealth Migrate, and I looked at it pretty hard. That I must admit, I think what really convinced me was the way that you were able to bring in such quality partners. I think Dorf de Rus was one of the people that I had read his books, and I was really impressed with him. And I thought, well, if Dorf de Rus is prepared to put his name in with Wealth Migrate, yeah, that must be a legitimate company.
Excellent, Lynn. And you know, the one thing that I'd like to, my final question I'd like to ask is I think you are epitomizing or verbalizing what most people go through, which is the fear. You know, Jean mentioned earlier, it's like, do I invest? Who do I trust? What trust structure do I use? You know, et cetera, et cetera. And people have a lot of, you know, concerns and fears. And so it's often very difficult to get started. But if you take even the last 6 years and how it's evolved from, you know, actually trying to go over and set up your own structure and have your own bank account and, you know, basically trying to do.
No, I can only sympathize with you people, because you know, you helped us first buy a property in America, and you know, the purchase went okay, but dear me, once we had it, oh dear me, we had to have a structure, because we were advised that if you actually held the property in your own name and somebody slipped on the stairs or something, they could really attack you personally from a legal point of view. So we started this LLC. And although the LLC only owned one small property, no, a third of the rental you received went in costs to pay the accountants to do the tax returns. So it was really, really heartbreaking, you know, seeing a third of your money just disappearing into admin costs. And as the company's progressed and you've moved into these commercial buildings that are bought off the platform, it's just become so much easier and so much cheaper. It really has been a pleasure.
No, well, thank you very much, Lynn. You know, I think what we're trying to do, and I really appreciate your time this evening, you know, what we're trying to do is just for other investors, you know, just verbalizing kind of the journey that you've been through. I believe that, you know, people can learn a lot from other people's experiences, and you know, I think you've epitomized what I was trying to say, because I too have been on the journey you've been on with LLCs and offshore structures and bank accounts. Someone like Thomas will phone me up and say, Scott, you know, give me the paperwork from 5 years ago. SARS wants it. And I'm like, are you joking? Like, you know, it's like, so to have everything in one place is really powerful.
I must admit your site, I mean, if you log in, every single transaction that you've done through your wallet is listed there from get-go. So, I mean, you can immediately say what you received and didn't receive. Yeah, so that helps.
Excellent, Lynn. Well, thank you very much for your time. I really appreciate it tonight. And
no problem at all, Scott.
Awesome. What I want to do is just conclude. I'm going to share my screen back here, and just to quickly run through, if for those that want a little bit more information. So Lyndon did talk about this, and we do have these breakfasts around the country. It is interesting. It is post-COVID. We are going to take all the precautions we can around COVID, but we do feel that as much as people want to do stuff online, they want to go back to being human, and they want human connection, and they actually want to meet people and look them in the eye. And so the idea behind it is that the morning session from 8 until 10 o'clock will be a theory session. There'll be 10 important reasons. So how to invest in property in the UK, Australia, America, Europe, and even South Africa, and to build a global portfolio. The 4 secrets to wealth used by the top 1%. The ultimate secret to creating wealth in real estate. So this is the whole residential and commercial side that Lynn has just mentioned. How to understand the risks and manage them. How do you choose the right countries, the right partners, and the right deals? The key strategy which is used to become a global citizen. I get asked all the time, where should I invest so that I can get a foreign passport or foreign citizenship, etc.? What about tax structures, bank accounts, and the process? And as we said, we're very excited that Tax Consulting is going to be joining us. How to create your own personal investment plan, whether you're starting with $100 or $1 million. How we work as a company. So how do our fees work? And ultimately, is it safe? And are we playing in a regulated space? And the answer is yes, we are playing in a regulated space, and we do have the regulated licenses. And then lastly, for us, the word we like is freedom, and how you can actually go out and create the plan that you want. So that's the theory session. Then we move to a practical session. And in that practical session, we'll actually be running through the platform. We'll be talking through the available investment opportunities, and we'll be highlighting the risks and how it works and how you can understand those risks. We'll be working through the models so that you too can create your own financial plan. We are going to have a Q&A with the team from Tax Consulting, which I'm really looking forward to, around tax and people being able to answer their own questions. And then you can basically see the Q&A there. We found from previous experience that in the breakfast session, and it's a morning session, that the first hour and a half, 2 hours, the theory is very valuable for people, but the second 2 hours is even more valuable because they actually walk away with a plan. And so, rather than the theory, you actually walk away with a plan. And so if you want to join us for the breakfast, that is the link. I know that Fritz has kindly put it into the chat box. You can actually go and read all about it, what the schedule is going to be, who the different people are. You can go in and book for any of the events. The fee is a nominal fee. It's literally 199 Rand. We don't make money from events. The only reason we actually charge a fee, you can see testimonials here. Lynn mentioned Dr. Dolph Duris and Clem Santa. You can go watch a video. And what's quite nice is you can actually go and check up the platform. You can go and read all the different step-by-step guides, etc. So there's a lot of material that's here. The reason we charge 199 Rand is that because of the COVID restrictions, we are limited, I think, to 30 people per venue. And quite frankly, we would rather have 30 people that are committed and have a good session than 100 that book and don't turn up. I learned a long time ago, when people pay, they pay attention. Our time is valuable, your time is valuable, and that is why we're charging just a nominal fee, so that we've got people that are committed. Why is it a morning? I fundamentally believe that the stuff we're talking about, and you can see already, tonight we've been at it for more than an hour. It takes time. This is your whole future. I fundamentally believe if you can't give up half a day of your life to create what you want in the future, then that's a problem. And that's why we put proper time, energy, and effort along with our partners to do this properly. The session that we really like to look at is how to become a global citizen. I just flew home right now. I've had the privilege of my first international flight since COVID. And I'm very grateful to be living in South Africa, but I'm also very grateful to be a global citizen. And that's what we want to share with people. And tax and structuring is such an important part to that. If you want to reach out and chat to any of our wealth consultants, please do. Both Fritz and Alex are here to help. We are a digital platform. However, we're with a human heart. And I think that is really important. And as we move into the Q&A now, our overall objective is to put smart investing in every single person's pocket. It's very seldom that people actually get to be able to ask the right type of tax questions, the right type of structuring questions, so that you can set yourself up for success. And that's why we've got partners like the guys at Tax Consulting, so that you too can do that in the right way. And that's what we call smart investing. Lyndon actually started the presentation tonight looking at some of the most important things, like don't lose your money, like be tax efficient, like diversification across countries, across assets, across currencies, and even across partners. And he also spoke about asymmetric risk and reward, which are the 4 fundamental pillars upon which you ultimately are going to build your wealth. And so, Lyndon, that is all from my side. What I would like to do is move to a Q&A. And if there are any questions, while we're doing that Q&A, because there's nothing to actually share on the screen, if you don't mind, I'm going to launch a poll. And I'd love to always get people's feedback, because the more we understand what your needs are and what you're looking to achieve, the more we can actually tailor-make the solution for you. So as I've already said, your time is valuable and so is ours. And the more that we understand what you're looking for, the more we can actually assist you. So Lyndon, back to yourself. While that poll is up, and please, I encourage people to fill in the poll. are there any other questions that we haven't answered? And specifically also, if someone can't make the breakfast, I'm interested from the team at Tax Consulting, how we go about actually setting up a one-to-one with them if the clients are keen.
So in each case, we are happy to deal with inquiries depending on the nature of the inquiry and where it comes from and what it concerns. It would either be a paid consultation or a free consultation, depending on the service line required. But that said, we are very open to discussing with anyone and everyone who needs to have that conversation with us. And they'll simply just need to drop us a line or an email, and we can take it from there.
Perfect. No, thank you, Thomas. And I think, the idea is that if people are interested and can make the breakfast, I think it'll be very valuable at the breakfast. However, if you can't make the breakfast, we will still have solutions. Again, we're very excited about this partnership with Tax Consulting because we have been overwhelmed over the last couple of years by clients asking us tax questions, and Lyndon, myself, and the rest of the team are certainly not tax experts, and that's not our intention. Our intention is to bring the best partners to the table so that people can get the answers they need.
Thanks, Scott. There are a few questions if I can dive in quickly.
Yep.
Francis asked, does the SPV we use always pay the withholding tax? So we as investors don't need to worry about this. Francis, that's 100% correct. I think, Lynn, great to see you online tonight. Thanks for joining us. And I think your story is one echoed by many people over the last decade who have gone and done offshore investing in the old-fashioned way. Which is, if you want to own a buy-to-let in the US or the UK, you have to go set up a company there, buy it that way, and then your company has to pay tax in the US, for example, before you can distribute. Because of digital transformation and the way the Wealth Migrate platform is structured, you no longer have to worry about any of that. We take care of all of that. For each deal, we actually set up a US company, but the economies of scale make sense at our level rather than individuals doing it themselves. And we pay USA withholding tax on behalf of a deal before we bring that money back into the UK LPs. So absolutely, we always take care of the withholding tax. There's no need to worry about that at the investor level. There was a follow-up question around do the returns, this is a great question, so thanks for asking this. Do the returns on the platform calculator have already taken into account any withholding tax? And the answer is yes. So we make sure that when we are showing projected returns on our platform, that we have already taken into account the projected returns that the sponsor is predicting. We then calculate what we envisage the tax through the life of that deal might be in that country, for example, the US, and the returns we display to you have taken into account that tax. So there are no surprises at the end. It's a core principle for us, transparency in the investment process. The returns on the platform also have taken into account any fees that might be charged. So the amount you see on the deal card is as true a reflection on a projected return as we can give you, having already taken out the tax piece that might be there and any fees. So that's a great question. Thank you for that. There's a lot of questions around wills and how to do that. I'd be curious before, I'm very hesitant to give legal advice or tax advice. I'm not sure, Tom or Jean, if you've ever had this question. If you do own an offshore investment, for example, like ours, do you require a will in the countries where you hold those investments, or is the South African will sufficient?
Well, in terms of how the actual property will be distributed, I think your South African will should be sufficient. I think maybe what they're wondering is how the asset will be taxed in the country where it is situated. And that will depend again on the local legislation, and also if we also have double tax treaties insofar as it relates to estate duty. I think we have one with the UK, but I think, in terms of our network on that, I think there's about 7 or 8 treaties across the globe. So that is quite limited. You'll have, it really depends on where the asset is located.
Another thing to take into account from an estate planning perspective is the differences in how different countries will treat this from a tax perspective. Now, to be clear, neither Jean nor I focus exclusively on estates, deceased estates from a tax perspective. We do have specialists who focus on that. But one thing that I can say, and this is something that does sometimes become relevant from a tax perspective, is that a country like South Africa will impose estate duty, which is a tax that's levied on the deceased estate itself. Other countries, such as the UK, impose inheritance tax, which is a tax that's imposed on the beneficiaries of the state. Or of the estate. So that's something that should also be considered from a tax perspective, although all of Jean's points are otherwise very much correct.
If anyone has specific questions around wills, please feel free to reach out to me on email. My email is linden@globalwealthgroup.com. I'm happy to provide what information we may have been given ourselves in the past on this. So please do feel free to reach out to me. Kathy has got a follow-up question on that. Kathy, I think if you could maybe just email me directly, that would probably be the best way for me to answer this. We do get this query a lot, so I can give the information that we've got, but I'm very hesitant to give that kind of advice tonight on this space, but I'm happy to give you the information we do have and have received in the past. And that's really it in terms of the questions. There weren't anything more that came through. So Scott, back to you if you'd like to wrap us up for the night.
Yeah, someone's asked us here, are those projected returns conservative estimates? So very much so, even at an investment committee level, they've got a low road scenario, high road scenario, which we are explaining to people, and there's even the mid road in terms of, so it does give people the estimates of what they're achieving and how they're looking at it. I think also there was a question here around the road trip next week and how long it'll be. So it's a half-day event effectively. Someone asked, how does one get rid of the legacy LLC the right way? That is something that we work on. Lynn actually mentioned that. I've gone through the same thing myself as a process to be able to help all our investors and to effectively be more tax efficient. So it's very much something we're wanting to work with. Any clients on the legacy LLC, please reach out to the wealth consultants. Francis said here, with regards to the wills, so you've covered that, Lyndon, I think. Dana asked, will they be streamed? So we do, again, understand that there's people in many different places other than those 3 cities. We are aiming to do those 3 live and then looking to have an online version of it afterwards. And I'm just trying to see.
There's a question here for Jean and Tom about how do they get hold of you if they need to.
I think what I'll maybe do is I'll just put down our email addresses. Let me just.
And then Tom, maybe for you, while Jean's doing that, can tax consulting assist with citrus taxes in the UK and the US?
So our scope is generally South African tax or international tax from a South African perspective. However, yes, we do have a very extensive group of partners all around the world, and there is very little that we don't effectively cover. So the short answer is yes.
Great. So Vishlin, there you go. Please, I see there have been some emails there. Please feel free to reach out to Tom and John on that.
Yeah, and I think probably the closing comment here, Lyndon, is that is exactly why tax consulting is the partner we wanted to partner with, because they've got that extensive network. Yes, I've got accountants. We've got accountants in America. Yes, we've got accountants in England. But the nice thing here is you're getting a holistic approach, which is exactly what you want for clients, basically. So I think to finish it off, someone's asked a question here, can we meet your team in a more personal capacity during the roadshow, as I'm concerned with the pandemic and larger crowds? Yes. Normally when I do one of these roadshows, we would do 4 cities in 4 days. we are now doing 1 city per week. So the idea is, if you would like to reach out, speak to us, we are setting up one-to-one meetings as well. And specifically with the guys at Tax Consulting, obviously that's an ongoing journey for our clients to be able to sit with them. And like Thomas said, there's different levels. Everyone's time is valuable, including theirs. And so if it's generic information, the breakfast will be the right place. If it's one-to-one, sophisticated tax planning, then there'll be a fee involved, but they can assess that and take that forward. So Lyndon, I think that's enough for tonight. I just wanted to say to everyone, again, just to remind everyone, we're not trying to provide tax advice tonight. We are really trying to share the caliber and quality of our partners, and the fact that you can get the answers that you want. Whether it was someone saying, I'm nervous, I want to invest offshore, but I don't know what to do. I don't know how tax works. I don't know how the structuring works, whatever it is. We've got the partners that can provide you with the information. And I fundamentally believe that the breakfast is a good way to start. If COVID is something you're concerned of and you want to meet with us one-to-one, reach out to us. We've given you all our contact details, both from Tax Consulting and from the team at Wealth Migrate. But I just wanted to thank you, Thomas and John. Thank you very much for being online. Lyndon, thanks for jumping in and helping me with my airplane being an hour and a half late. And Lynn, thank you for sharing your experience. I think it's always very valuable for others to hear people's experience, and to all of you who've been online tonight. We really appreciate all the energy. It's been wonderful, all the questions. And if we haven't been able to answer the questions, please keep them coming. We are wanting to, I know that Jerry and Lyndon and Rion, who's our CIO, all met, and we are wanting to put together like an FAQ booklet where investors can work from that. So it is something we are looking to work over time. That's all from our side, Lyndon.
Yep,
Thanks,
that's all from us.
Thank you.
John, Tom, good night. Lynn, thank you for joining us. For everyone, please stay safe, and hopefully see you on our roadshow or at our next series of webinars. Thank you very much, everyone.
Absolutely.